A very good afternoon, good morning. Welcome to live market analysis with myself, Giles Coghlan, Chief Market Analyst. I do hope everybody is well. Looking forward to getting into the session. If you can just let me know you can see my screen and hear my voice okay, that would be great. And as we get stuck into the webinar, I'm just going to, before we do, just make it clear that as we talk about different entries, exits, different instruments, the whole idea of this webinar is that it's a educational webinar, and that by looking at and attending this webinar, you can see you're looking, as it were, over my shoulder and seeing how a professional analyst and trader goes about making trading decisions. And from that perspective, it's a learning experience. What it isn't is it's not a signal trading service, so that's just to make it clear in case some people misunderstand. And obviously it can't possibly be a signal trading service because market dynamics change so frequently. But what I'm doing is I'm locking how I'm viewing the market so you can see those market dynamics and begin to watch them as they play out and learn for yourself how the market moves in certain situations. Now, the workshop we'll be doing this week is what to expect from the Federal Reserve rate meeting on Wednesday. Now, this is all about the Federal Reserve this week. Expect markets to start closing up in terms of their movement. Expect low volatility the closer we get to the Federal Reserve meeting. And we're likely to see some volatility after Wednesday because we've got the Federal Reserve meeting and traders will have a much keener view of what's going to be happening with the dollar, happening with gold, silver, stocks. And then we've got the ECB decision and the Bank of England decision. So we've got a really, action-packed week this week. And then we have got the US CPI inflation tomorrow. So there's a lot to be looking at. The key outlook for the dollar, we're covering that, and US stocks and gold. We'll be looking at that with silver. So that's what we'll be looking at for the Fed meeting, mainly on Wednesday. So do make sure you attend on Wednesday and look at that workshop, because on that workshop I will be running through what you can typically expect from those instruments, and I'm also going to point out a very strong seasonal pattern in platinum, which I'd like to get to straight away because that's an amazingly strong seasonal pattern that you just have to be aware of. So I'm just going to look at that soon before we really get stuck into the session. Now, if you let's just find here, if you take a look at platinum, you really need to see this. Now, if you take a platinum and if you look at platinum prices from now through to February the 20th, what you're going to see, look, in the last 25 years, platinum has only lost value once in 2014. Do you see how incredibly strong that seasonal pattern is? The maximum drawdown has been, I think, around 4.5%, no, 7% here in December 2015. So, and the average return has been 9.89%. So in terms of commodities to consider for a seasonal pattern, wow, platinum commodities gains have been absolutely huge. So just look out for platinum. If we have a reason for a weak dollar outside the Federal Reserve, then buying platinum around the turn of the year for the year does make a lot of sense. So just watch out for that. We'll be looking at the Federal Reserve as we go through what to expect for the week ahead. I want to do a quick look about what's going on in terms of markets overall, just so everybody's up to speed. So first of all, we can see that stocks have been tracking lower, and that's because markets have been growing in expectations that inflation is a little bit stickier than markets have been sort of anticipating, and US labor has been a little bit firmer. So better wage data, better employment data, and stickier inflation has all meant expectations have been increasing that perhaps the Federal Reserve may have to be more hawkish when they meet on Wednesday. That's been a pressure on stocks, except for Chinese stocks, which have been steadily gaining on reopening hopes. That particularly, we saw a boost in China's 50 when we looked at the prioritization of vaccination of the elderly. And on HYCM's blog, of which I am the main contributor, I did highlight the pivot that was really taking place. And many sort of commentators missed it, but it was this vaccination of the elderly that really made a big difference. And you can see here back in November, I was just saying that this COVID zero has a very limited life, and as soon as we started to see the acceleration of the elderly being prioritized, we saw that as bullish. And we said all the way back in May, I pointed out that one of the problems was that half of 80-year-olds hadn't been vaccinated, so the operation would be vulnerable to a more open society. There was that vulnerability that was stopping China pivoting. But once they said they were prioritizing that, that was one of the key reasons I was confident in the China's 50 gaining. And you can see, all the way back from that November piece that I did here, and I'm just sort of saying, this is the reopening argument is unhelpful back at the 4th of November. And you can see here back in 4th of November, no, wrong instrument. You can see here all the way back in the 4th of November, just really, obvious to me that this, a lot of this dovish and bearish sentiment has been overdone. And we've seen China 50 really push high. And if you look at this from a longer term trade view, you can see, look, this trend line going all the way back to 2018, price is now broken back above it. This does open up a move back up to 13.5 and back up to 1400. And if you look at China's 50 from a medium-term perspective, you've got this 2-bar reversal on the monthly chart, which is basically, a hammer reversal bar if you looked at it on the on a 2-month candlestick chart, and the rejection of those lower prices. So when you consider that China's 50 has fallen nearly 50% from January's 2021 highs, right? So that's a huge drop, and eventually I have been anticipating China's 50 to gain. So a longer term, I am bullish on China and have been buying in on these dips. So not trading advice, but I'm expecting China's 50 to keep moving higher. Now the next signal for longs for me would be if we saw a nice break of this trend line here. So if that trend line, if we see a break higher and stay above, then that opens up a retest of 1400 and then up to 1500. So that's something to be looking at very carefully on the upside. Okay, it's a nice little trend line and worth being aware of. Now, US stocks have been really in an interesting juncture. We've seen price move up to this overhead resistance, and now price is selling off. And what will be decided on Wednesday is whether stocks continue to drift lower from here, or they can push higher above that trend line. Now, stocks tend to have a very strong end of the year. You just take a look at the seasonals for US stocks. What you'll see is that, just look here. Just look. All right. You'll see that from now and the end of the year, to see how much in the last 25 years, 17 gains, 8 losses. And if you go back like from the 14th of December, you can see 20 gains and only 5 losses. So that's not just true for the S&P 500. You'd also see very similar pattern for the NASDAQ, 17 gains, 18 losses. You'd also see similar for the Dow. If you just look at the Dow here, 17 gains, 8 losses. So there is a predisposition to buy US stocks into the end of the year. So what that means, going back to our charts, is that if Jerome Powell is very dovish on Wednesday, then that could result in prices pushing above the overall trend line and maybe a retest of that 4,200, maybe even that 4,300 region. But, and remember, we've got 200 moving average being rejected here. If Powell is more hawkish and suggests rates have to go higher than the markets have previously expected, then this is, technically trying to push, prices are trying to push lower. And if you look at this on the daily chart, you see you've got this near-term trend line, broken, retesting, rejecting, hawkish Powell, then we expect this to move down to that 3,800 region. So watch out for that on Wednesday. Now, I want to briefly start getting us into the frame of mind for what's going on for the Fed, because that's going to be the main decision this week. The interest rate curve for the Federal Reserve has been shifting recently. And basically, Fed funds expect interest rates to peak higher, that's the blue line, but fall lower. So if you think about what this means, it means that they're expecting interest rates to rise to 5% around the spring of next year, 2023, but then to fall to about 3.50% in the summer of 2024. So they're expecting sharper hikes and then a typical recession, rates being cut. However, and this is the issue, if inflation remains stickier and the US jobs market remains firmer, then this pricing that the market has could be wrong. A month ago, markets were pricing a kind of a slower rate hike up to around 5%, but then the rates to stay elevated for longer. They're now expecting, inflation to definitely peak. Now, the problem is there's a mixed picture here. In some senses, yes, inflation swaps are expecting lower inflation coming up, and they're expecting inflation to be below 3% next summer, right? So that's good news. But, and part of the reason for that is that inflation drivers are seen to be falling. The Federal Reserve, which has been having very low interest rates, was supporting inflation. Now those interest rates are being hiked. So you can see here that inflation factors from the Fed are falling. Stimulus, fiscal boosts are all being cut back as markets are no longer being supported by huge amounts of government spending. So fiscal stimulus is now falling and is no longer such a great inflationary pressure as it was. We also can see supply chain issues are starting to fade. The Russia-Ukraine war is stabilizing in the sense that the inflationary, particularly in the food factors, although it's not, there are risks involved with this, some of the inflationary factors are falling and energy prices have been falling as of late. So inflation drivers from a geopolitical perspective and a fiscal perspective, as well as a monetary policy perspective, are all generally moving lower. But you can see that producer prices, although they fell last week to 7.4% year on year, below the 8.1% price, it is trending lower, the prices that producers are having to pay. This was 7.4% and only I think it was about 6.8% expected, so it's still firmer than expected. And we see that the core PCE print that we had the week before is still fairly robust, above 5%. All of that means that inflation hasn't necessarily crashed, even though it is still falling. So what all of that means is that the outlook from the Federal Reserve may have to be more aggressive. If the Fed's aggressive and more aggressive than the market is expecting, remember what's expected at the moment is a 50 basis point hike, right? That's 100% priced into markets. Just take a look here. And you can see, courtesy of the financial source interest rate probability tracker, you can see there's 91% chance of a 50 basis point rate hike, only 9% of 75 basis points, and expectations have been pretty flat heading into this. So it's, 50 basis point hike is what's baked in, and the peak is expected to be just around 5% next year. So current interest rates going to get a 50 basis points hike, and then there's 50 basis point hike being expected for February. Now, exactly where interest rates go from here does remain to be seen, but that's what the expectations are. So taking that knowledge, the that will be guiding us as to what to expect for the US stocks. If the Fed is more hawkish than that and says we're going to have to go higher than 5%, you know, they sort of say sort of 5.5%, and expect stocks to fall. We'd expect the dollar to rise. We'd expect gold to fall and silver to fall. You see, gold has been flirting with this huge trend line on the daily chart. You can just see, let's just go to the weekly chart just so you can see how strong this trend line has been. You can see here, just going through those swing points here. That, you know, we can actually we'll take this swing point, it'll be good enough, right? Now, that's technically not necessarily a valid trend line, but in my experience, when you get this tailing action like this, that's good enough. So prices try to break over that trend line, but now we're finding some resistance to the 200 moving average. And if the Fed are hawkish, then expect this to fall lower. Next support is around that 1740, 1720 region. Now on the monthly chart, we're seeing some pretty decent rejections from these lower levels. So I am expecting dip buyers at around 1700, 1680, and I would happily buy the dip myself because I'm expecting the stagflationary environment to be supportive for gold. But I'm not interested in buying at these prices unless Jerome Powell is extremely dovish on Wednesday. So in terms of what to expect with the major currencies, then we would be expecting the dollar to strengthen on the hawkish Fed, and that would weaken the majors, or weaken on a dovish Fed, and that would strengthen the major pairs. So that's the broad outlook. Do come back on Wednesday. I'll go through that in some detail. Now, in terms of what to expect for the rest of this week, here's what to be looking for. Kicks off really tomorrow. We've got UK employment data due. I'm not expecting that to move markets at all. If it's a bit better than expected, so what? Doesn't change the UK outlook ahead of the Bank of England. If it's a bit worse than expected, so what? Either way, I don't see a tradable opportunity there. Although if the news is dire, then that could result in some pound downside, but I won't be trading the UK employment data. I don't see opportunities there. The opportunity I do see is with the US core inflation and headline. Now, the core inflation rate is expected to fall from 6.3 to 6.1 and 7.3 from 7.7 for the headline. Now, often the PPI print can give an indication of what's coming for the core inflation print, the CPI. And the PPI print was hot last week. So what that means is I'm expecting a hot number. If we get a hot number, all it's going to do is increase expectations for the Federal Reserve. The only opportunity that I see from this is if we have a big miss. So if I see headline come in below 6%, sorry, if I see the core come in below 6%, which is below the minimum expected, and if I see the headline coming in below 7.2%, which is below the minimum expected, I would see an opportunity to scalp along in gold. But I wouldn't be holding the position because the Federal Reserve are meeting on Wednesday and the volatility will probably go back through the entry. So it's only a scalp position. I'll be looking only for a miss to trade. If I get a miss below 6% for the core, below 7.2% for the headline, I'll be looking at scalping gold long or the S&P 500 long. And what I'd be anticipating is a short move higher, maybe up to the next pivot point or an overhead resistance level, where I would definitely be taking profit because all eyes will then be on the Federal Reserve. That's the opportunity that I see. That's the opportunity that I'll be looking for. Then we get to Wednesday. We've got inflation data out for the UK. Again, the best opportunity would likely come from a big miss. And if we saw a big miss in the data with the headline coming in below 10.5%, and we see the month-on-month data coming in below 0.4% and the core coming in below 6.4%, then I would potentially see some opportunities in the pound, but it's not something that I would feel confident in trading because If we saw a big miss in the data, then you could see that actually being positive for the pound, because markets will think, okay, you know, the stagflationary environment is receding. Or you could see a big miss in the data, seeing a flush lower in the pound because the Bank of England would need to be less hawkish. I'm not sure which narrative investors would focus on. My gut is that they focus on the stagflationary environment, but because the picture's not clear, I would leave that, particularly because we have the Federal Reserve meeting at 7 o'clock later in the evening. That's the tradable decision. I will be going through what I'm looking for on Wednesday's workshop at 12:30 UK time. This is the best trading opportunity of the week. It's likely to provide some good scalping opportunities, and the best opportunity would come from a dovish Federal Reserve. So if Powell is dovish and says, you know, we've kind of hiked enough, we're confident inflation's falling, we don't want to over tighten, we're concerned about slowing growth, anything like that, then I expect upside in gold, upside in silver, upside in the S&P 500, downside in the dollar, upside in euro, US dollar. That's the best tradable opportunity. There's also a tradable opportunity if the Fed are more hawkish. This can work both ways. If Powell says, you know, I think they'll have to, you know, hike higher than we previously expected for longer than we previously expected, then we'd be looking at another down leg in S&P 500, and we'd looking at some short-term selling in gold and silver. I will cover that on Wednesday. GDP growth rate likely to get some attention and moves in the New Zealand dollar, so watch out for that. If you are up for the event, then it would be, if we see a big miss in the data, below 4.9% for the quarter year-on-year GDP growth rate, below 0.6% for the quarter-on-quarter, then I'd expect some upside in the Aussie New Zealand dollar. Not trading it personally, but that's what I'd look for if I was up. Aussie employment data, RBA have sort of said they can go either way. They can hike rates or slow down hiking rates. So labour data will be important. And if we see a miss in the employment data, then that's likely to result in pressure to the downside for the Australian dollar, but not something I'm looking at trading, even though I'd expect that. Then we have Thursday, Bank of England interest rate and the ECB interest rate decision. Big day on Thursday. Now, Bank of England are expected to hike interest rates by 50 basis points, and you can just have a look here, and you can see Bank of England markets have, you know, been fully expecting a slightly slower path up to around 4.5% in the summer of next year, and you've got this, you know, 50 basis point rate hike that's 90% priced in. So that's the expectations. If it's only 25 basis points, then that should allow a flush lower in the pound. So if we see only a 25 basis point rate hike, that's not as hawkish, should expect maybe upside in the euro pound for a short scalp. Or you'd expect some kind of weakness in the pound. So have a look what the dollar has done the night before. That might give you an opportunity in the pounds, depending on what the dollar does. Then not long after that, we've got the ECB meeting. Again, ECB's turned a little bit more dovish recently, 74% chance of a 50 basis point rate hike. So that's what's expected. And the outlook for both the Eurozone and the UK is pretty bleak. So I'm expecting projections for recession for the UK. Last interest rate meeting, there was seen to be 5 quarters of recession ahead for the UK. Does the Bank of England extend that? What's the anticipation for growth? Has it fallen further since the last meeting? If the Bank of England is less optimistic, we could see some of that pound recent strength recover, particularly if we see any dollar strength. So if there's any reasons for dollar strength the night before in a hawkish Fed, selling the pound could make sense, because it's very unlikely that the UK comes out positive. And if you look at the recent gains we've seen in the pound US dollar, a lot of these gains have mainly been to do with a retracement in the dollar. Do you see the way the pound has gained? You might think, oh, look, the pound's doing great. This is not really pound strength. This is more dollar weakness. And if you look at the dollar index, on an index level, look, you'll see, look how much the dollar as an index has fallen over the last few days and weeks, right? So that's what the pound strength is about. Pound's been heavily oversold, the dollar's retraced. That's allowed the pound to push higher. So if we have a hawkish Fed and then a dovish Bank of England, expect pound US dollar sellers. So look out for that. Similarly with the ECB, outlook is very bleak for the ECB. It's on a semi-war footing with Russia and Ukraine, surge in energy prices, very high inflation, prospect of a coming recession, the looming US recession, which the Fed are anticipating for 2023, according to their last minutes, and growth hasn't necessarily started to pick back up extremely quickly in China. All of that means the outlook for the ECB remains bleak. Is there a tradable opportunity there? I can't really see one. We already know the news is bleak. We already know we're expecting 50 basis point rate hike. It'd be very hard to see what the ECB do as a surprise, so not much there. US retail sales will be worth looking at depending on what the Federal Reserve do and say on Wednesday. If they start to raise concerns about slowing growth and then there's a big risk in retail sales, then we could expect any moves from the Federal Reserve on Wednesday to be accelerated or continued with the retail sales. We then have PMI data coming out later on in the session, and again, expect this to be read on Friday. Expect that PMI data to be read in light of what happens from the Federal Reserve on Wednesday. We also have a whole string of PMI prints on Friday. Don't see this as tradable because we already know the outlook is bleak for the UK and Europe. What can they really say that changes it? These data points, they're all expected to come in contractionary territory below 50. We already know the bad news is priced in. If it's bad news, that's nothing that people don't know. If it's good news, then we know that any good news is likely to be lost in the wider issues that are facing Europe with the Russian-Ukraine crisis, surging energy prices, high inflation. So even if the data comes in above market's maximum expectations, you may see a quick flush higher, but then I would expect that to be quickly sold. So to be honest, if I was trading this, I would probably trade a spike higher and look to potentially fading that. But don't forget, we've got to let the Federal Reserve decision on Wednesday guide the strength of currencies for the following days. This is going to really be impacting the dollar. Huge, huge day. So that's what we need to get ready for. Hi, Max. Yeah, no worries. I think everyone was in a bit of a go slow today. It must be the Christmas spirit. We had a bit of a slow start, so you weren't the only one, Max. No worries. Don't forget, pick up the recording in case there's anything you're not sure of. Workshop topic will be back here on Wednesday. Going to get totally ready for the Fed. Best opportunity for the week. Can see some good opportunities there, so I will be running that through with us all. Okay, folks, I do hope everyone's well. Take care of yourselves, and I will be back here on Wednesday. Thanks, everyone, now. Goodbye.